It's one of the basic rules of investing. The less time you have to invest, the more stability and certainty you need to add to your portfolio. And as you get closer and closer to retirement, or as you get older, you could be putting your investments at risk by staying invested heavily in stocks. So what's the alternative? Hi, I'm Suro Ghatak, Director of Investment Management with the Noble Group. Let me tell you about one of our clients. We'll call him Larry. Larry was what I would call investment savvy. He had done well in the markets with growth stocks such as Nvidia and Tesla, but he had just turned 64 and was contemplating retirement at 65. Because of this, we suggested he take down his equity allocation from his current 95%, which was quite high for his personal situation, and invest some of his money in bonds. When we presented our recommendation to him, he was rather taken aback. And to put it lightly, questioned our intelligence, integrity, and sanity because he was so opposed to a bond strategy. This is how a lot of people react when we first suggest adding more bonds to their investment mix. Quite understandable. Bonds are often seen as a less than ideal option for investors, regardless of their age or financial situation. But in this video, I'm going to share with you 3 really good reasons why bonds may be worth holding in your investment mix, show you the mechanisms behind how they work, and explain how you can begin to smartly invest in them. Let's start with one of the key reasons that bonds can hold value in a financial plan. Bonds generally have lower volatility than stocks. Historically speaking, stocks have returned about 11% annually and bonds 4.8% on average. But it's the range of returns that is markedly different. The best year in the stock market was 1954, when the S&P 500 returned almost 53%. And 1931 was the worst year, when the S&P 500 declined by almost 44% around the Great Depression. Bonds, on the other hand, had their best year in 1982, returning almost 33% as the Federal Reserve Bank appeared to be winning the battle against inflation, but had their worst year in 2022, when the bond markets declined 17% as inflation spiked to over 9%. So what does this mean? Bonds are a good buffer to stocks. When we review annual market returns since 1928, we see that stocks were up about 73% of the time and bonds about 79% of the time, so not much difference there. However, what might surprise you is that it is extremely rare that bonds and stocks have both delivered negative returns in the same year. It's only happened 3 times, 1931, 1941, and 2022. Having some bonds in your portfolio was actually additive to returns during the rough years. Now, this makes perfect sense. In times of uncertainty, investors generally shy away from stocks and seek safe haven asset classes such as bonds. So, due to the relatively low correlation between bonds and stocks, the benefits of diversification are evident. Fact number 3, adding bonds to your portfolio adds certainty with very little loss of returns. This may surprise you, but as you can see from this chart, going from a 100% stock portfolio to a traditional balanced portfolio with a 60-40 stock-bond mix, the average return dropped by only 2.6%, but volatility was reduced by almost 30%. By placing 40% of your portfolio in bonds, the range of returns was reduced from 79% to 55%. Now, of course, this means there's less potential on the upside. But for those of you who don't have much time to ride out the market, like our client Larry, who is just a couple of years away from retirement, we would much rather reduce his risk of losing money, because too large a loss at this point would mean his portfolio would never recover. So now that we know how bonds can play an integral role in stabilizing a portfolio, how do they actually work? Well, at their core, bonds are simply loans. However, instead of you being the borrower, like with a student loan, car payment, or a mortgage, you are the lender. In return, you receive interest payments from the borrower. So how are bond prices determined? When interest rates rise, bond prices fall. When interest rates fall, bond prices rise. Bond investors use a statistic called duration to measure the interest sensitivity of a bond. The higher a bond duration, the more sensitive it is to a move in interest rates. It also stands to reason that longer duration bonds pay higher yields, because the longer you lend money to someone, the greater the risk associated with that investment. For example, the price of a bond with a duration of 10 years will depreciate 10% for a hypothetical rise of 1% in interest rates. Conversely, a 1% drop in interest rates will mean a 10% price appreciation. Of course, the interest payment received from a bond acts to offset any price depreciation. So investors need to understand what kind of interest rate sensitivity they can handle, and it's different for everyone. There are a lot of bonds out there, but not all are created equal. While bonds with very high yields may be tempting, if the issuer stops payment of periodic interest due or doesn't pay back the principal amount of what you lent them, that bond is a lousy investment. The term we use to assess the financial condition of the borrower is credit risk. To help bond investors, independent rating agencies such as Moody's, Standard & Poor's, and Fitch assign ratings to reflect the perceived risk to investors being able to recover their investments. The ratings range from AAA for the strongest credits down to C or D for the weakest credits or those in default. Bonds rated AAA down to BBB- are called investment grade. Bonds BB+ and lower are considered below investment grade or speculative grade, or colloquially just junk bonds, and have much higher default rates than investment grade bonds. Junk bonds are high-risk investments, and we are highly selective in recommending them to clients, and then only as a small part of a larger bond portfolio. So what are the different ways to invest in bonds? Let's walk through them and determine the pros and cons of each option. The first option is to buy individual bonds, but given the granularity of bonds they trade in is $1,000 units or greater, you would need a large sum of money to create a diversified portfolio of bonds. Bond markets, except for US Treasuries, tend to be very illiquid, and buying smaller lots of bonds can be expensive. Also, some of the best opportunities in the bond market, such as mortgage-backed securities, structured products, or international bonds, are not available to individuals because they are research-intensive products and tend to trade in lot sizes expressed in millions or often tens of millions. The second option is to invest in bond funds, separately managed accounts, or ETFs. By pooling investors' money, professional managers can create a diversified portfolio of bonds across different maturities, companies, and sectors. They can actively manage those holdings by selling issues that have done well or buying attractively priced issues with good fundamentals. The downside of this is that the prices of these funds fluctuate with the state of the economy and capital markets, possibly presenting the risk of adverse timing when investors need the money the most. The third option is to create a bond ladder. Investors can create a portfolio with a pool of bonds of staggered maturities, also known as bond ladders. As shorter dated issues mature, the proceeds are invested in longer and longer dated issues, keeping the overall duration of the portfolio relatively constant. Given that bonds almost invariably are retired at par, $100, there is far less chance of adverse timing. Bond ladders are particularly well suited for elderly investors who need the steady cash flow and predictability. Most bond ladders are created with municipal bonds. Exiting a bond ladder in a hurry can be challenging due to liquidity. So ensure your time horizon when you need the funds matches the maturity of the investments. Successful bond investing is about balancing returns and risk. They can have a place in your portfolio depending on factors such as time horizon, your tax liability, liquidity, and your unique needs and circumstances. This is where working with a financial advisor can help you achieve your financial goals, balancing your return opportunities with the appropriate risk. If you want a personalized look at your finances, click the link in the description and we'll record a short video for your unique situation. Thanks for watching, and we'll see you in the next video.